Stocks climb on a halt in hostilities in the West Asia. IT, consumer durables perk up, industrials and utilities sulk.
Tata Motors tells CNBC-TV18 there is no production cut expected over rare earth magnets in the next few months. But 20% of its CV sales go via the Strait of Hormuz, and they are working on alternative plans.
HDB Financial's 12,500 crore rupee IPO opens for subscription after receiving a strong response from anchor investors. The management tells CNBC-TV18 discussions with the RBI on overlap of business which HDFC Bank are still on, even as its operations are completely independent.
Reliance Group Chairman Mukesh Ambani, in an interview to McKinsey, says he expects Reliance to live on long after him by focusing on future businesses and reinventing itself to deliver societal impact. He says the big challenge will be the confidence of NextGen to succeed in the new landscape.
The biggest risk we took was Jio, says the Reliance Group Chairman Mukesh Ambani, adding that the worst case was Jio will fail, but it was own funds being invested. So even if it did, digitizing India would have been the biggest philanthropy for Reliance. Watching us here on Halftime Report from CNBC-TV18, the Motilal Oswal studio. This is the launch of the Axiom Mission 4 to the International Space Station, happening as we speak. You can see that on your screen. This includes India's Shubhanshu Shukla, who will be the pilot of the spacecraft. This mission, remember, involves private space firm Axiom Space and Elon Musk's SpaceX. The 4-member crew will travel aboard a new SpaceX Dragon spacecraft, docking the International Space Station. The docking is expected at around 7 a.m. on Thursday. So there's the countdown. It's at 8, 7, 6,
5, 4, 3, 2, 1. Ignition and liftoff.
For 3 nations, a new chapter in space takes flight. Godspeed, AX4.
Wonderful visuals, them. Successful liftoff so far, 30 seconds post liftoff. We do have Shubhanshu Shukla, Indian pilot of the spacecraft. It will be reaching or docking with the International Space Station in the next couple of days, 7 a.m. on Thursday. These are the parents of Shubhanshu Shukla. A fair amount of pride, I think some sort of, a lot of happiness, and also the worry of their son being in space. They will be praying for the success of the mission and obviously the well-being of everyone on that itself. Moment of pride for the parents, as the son brings a lot of joy, not only to the work that he does, but also to the entire space community and, more importantly, the nation.
Well, that was very interesting, very inspiring visuals, and we hope, whatever it is that they've set sail towards, they accomplished the mission quite successfully. But moving on, the 12,500 crore IPO of HDB Financial Services, the largest of the year so far, has opened for subscription today. The price band is set between 700 to 740 rupees a share. IPO proceeds will be utilized for future capital requirements. Earlier today, we spoke to G. Ramesh, Managing Director at HDB Financial Services, to understand the company's business and future outlook. Let's listen in.
What we believe is that India is a huge opportunity for our business. And just to clarify to our viewers that we are a subsidiary of HDFC Bank, but we do not get any business from HDFC Bank. We are independently an entity. We don't get leads from HDFC Bank or any of the group companies. And that's been since inception. We run our own origination, our own risk management, our own collections, our own technology stack. We provide some BPO services to HDFC Bank and only to HDFC Bank. It's in the nature of collection services and some back office work that we do for the bank. That scale of that business really depends on the volume requirement of the bank. In the last few years, the bank has invested in digital capabilities, so some of the requirements have come down. While it's a significant part of our revenue, it's a very small part of our net revenues, which is our profit after tax. Given that our loan book itself is now 1,07,000 crores and generates significant revenues, it's a small portion of our net revenues in that sense. So not very material from a business perspective. Essentially, the draft rules came out about 8 months back, right? And the draft rules are really a document that's put out for discussion, which enables the industry to give its feedback. And the feedback has gone back to the regulator, and they're looking at the feedback. And as per the annual report, they're looking at the feedback. As I said, for us, the business is independent of the bank, right? And so very difficult to look at what might be the final circular at this point of time. The reason why we set up this business, independent business, is because we chase a set of customers which are fairly distinct from what the bank does, right? Or from what retail commercial banks in India do. For example, we have 19 million customers and 1,07,000 crore balance sheet, which means that our average ticket size is just about 1,65,000. We only do retail lending.
Well, that's then a very important IPO, very large IPO coming in from the HDFC Bank stable. But moving on, this is a special segment, Value Plus. Mangalam, you've been looking at the Timex Group, some important developments overnight, a large OFS, a large supply and offering. What do you make of it?
Well, it's a very interesting deal that has happened. One which has happened earlier as well, where the foreign promoter looks at the Indian company and tries to offload some stake out there. But, this is beyond that. We're just trying to look at what the business does and, more importantly, how it's valued as well, and who the buyers in that could be and what they get out of buying this as well. So for starters, the news is Timex Group Luxury Watches BV, which is the promoter, holds about 75% stake in the company, wishes to sell 15% via an offer for sale, and the floor price is 175 rupees. Now, you would see the stock lower by 5% today. Remember, the previous closing price was 264 rupees, so the floor price is actually nearly a 35% discount to the previous floor price or previous close price itself. What does the company do? The Timex Group, on the whole, is America's oldest watchmaker. They design, manufacture and distribute watches and jewelry for brands. Not only do they have their own brand, but they also have manufacturing operations for brands like Versace, Guess, Furla, UCB, Ferragamo. So a lot of these designer brands outsource their watch manufacturing to Timex. They have multiple sales touchpoints in India. If you look at their India business itself, from FY22, ignoring FY21 because there was the COVID impact, there has been a steady rise in the sales. And EBITDA in FY22 was obviously impacted by COVID, but thereafter it has been in high single digits for most part of the last 3 years. The only problem with the business, along with everything else, is the inventory days. Because if you look at it, FY22, the inventory days were 130, and that has inched all the way up to 180. That's nearly 6 months of inventory lying on your books, and that has an impact on their operating cash flow, etc. as well. Where does 538 crore in revenue stand when you look at all the other companies? You have Titan, obviously head and shoulders above everyone else, 4,500 crores. This is their watch business, and an EBIT of 553 crores. HMT, it's a PSU, which is a very slow-moving company and a lot of legacy costs. So they make an EBIT loss of almost 111 crores on meager sales of 163 crores. So take that out. Ethos, again, not an apples to apples comparison, because Ethos is a watch retailer and not a watch manufacturer or a watch owner. So we have them doing about 1,250 crores in sales versus 130 crores in EBIT. If you look at, Titan as a direct comparable, analysts value Titan anywhere between 25 to 30 times EV to EBITDA, valued between 15,000 to 18,000 crores. Timex watch at the floor price is actually valued at 25 times FY27 expected EBITDA, which implies that it is pretty much at par or maybe at the lower end of where Titan's valuation is, and understandably so. What are the triggers that you'll be looking at from here? One, because it's an OEM business, increased order from brands, their inventory management. I will personally be watching out for how they manage their inventory. Secondly, they are focusing on increased share of revenue coming in from e-commerce. And last year, they acquired Just Watches, which is an offline retailer. So them, supporting offline retail and growing their sales from here on is something I'll be watching out for as well. But Timex is a has-been sort of brand. What are the risks? Disruption in import of key raw material, because a lot of their raw materials are imported. Secondly, increased penetration of smartwatches, for which they don't have much answers. Thirdly, they have a high reliance on Flipkart for OEM business. So any change out there could impact their overall business. And finally, it's an MNC owned by a foreign parent. Any royalty imposition coming in from the parent could be a bit of a risk as well. So those are a couple of things we'll be watching out for. Timex at floor price, priced in line with what the other watchmakers are, but they do have their fair share of risks and opportunities.
Well, thank you so much, Mangalam, for telling us exactly, what are the key risks, the key perspectives as far as this particular OFS is concerned. Doesn't this also indicate, a growing trend where you're actually seeing MNC promoters go ahead and sparing stake in the Indian companies, and in most cases, the Indian subsidiaries or the Indian entities are trading at much higher valuations. Right?
That's absolutely true, and we've seen that with Whirlpool. We've seen that with a lot of the other companies as well, which are looking, in fact, not only selling their stake in Indian companies, but a lot of times exiting the India business on the whole as well. So let's see where this goes. But from a Timex standpoint, I'll be very interested to see how the business itself does. But speaking about Timex, don't lose sight of Titan. Titan's actually moved to the high point of trade. A large part of that can be attributed to the positive note that has come in from Macquarie this morning. So Titan up around 3%. And on the heels of Titan, we have some gains on the back of that coming in for Kalyan Jewellers as well, because Macquarie's thesis is that the first quarter demand has been fairly good. Timex is lower, pull up Titan and pull up Kalyan Jewellers, both of them doing extremely well. Kalyan Jewellers is up around 4% as we speak at the high point of trade. So jewelry business doing well. But let's get you some interesting insights from Mukesh Ambani, the Reliance Industries chairman, who spoke to McKinsey and discussed how clarity of goal and purpose accompanied by the right people can drive innovation, unlock extraordinary talent and create impact. He also spoke about the big bets that Reliance had taken, emphasizing that Jio was the biggest risk that the company had taken so far. Reliance was investing their own money into the venture, even as analysts voiced concerns over India being even ready for advanced digital technology. The worst case scenario for them was that the company would not earn much return. Even at this time, the philosophy at Reliance was that it would be the best form of philanthropy for India, as they would have digitized and transformed the country. Mukesh Ambani also spoke of Reliance's plans in the domain of artificial intelligence, where the purpose again is to solve complex problems and create wealth for the nation and its people. He highlighted that this has to be the reason behind Reliance not entering the ultra-high risk GPU game and deciding to take the downstream route. Reliance is also making a big-ticket entry into green energy with one of the world's largest manufacturing ecosystems for clean energy, which covers solar batteries, hydrogen, and much more. Also, the Reliance Industries chairperson says that this will be the company's contribution to saving the planet from the looming climate crisis. Speaking of the future, Mukesh Ambani said he remains confident that Reliance will continue to serve India and humanity well into the future, but also warns that the confidence of the next generation to succeed in a developing landscape will be key.
Welcome back to HTR. Well, there's a bit of a correction from the higher levels, especially if you look at some of the capital goods names. They're seeing a bit of corrections. Names like ABB India, Cummins, all of them now trading near the day's lowest points. But we'll now shift focus to the financial space. In a recent note, JM Financial says investors are worried about muted loan growth in the sector. They also expect largely flat net interest margins in H2 of FY26. We are now joined by Ajit Kumar, lead research analyst, BFSI at JM Financial Institutional Securities. Thank you so much, Ajit, for joining us. First up, give us the main feedback that you've received from investors. Despite so much of liquidity injections that the sector has received, you're saying that investors believe that they don't expect too much of credit growth as far as FY26 is concerned. Why is that?
Yeah. So thank you for having me. So yes, we met around 25 foreign investors in Singapore and Hong Kong last week on India financials. Their feedback was mix of caution on current state of affairs with hope of recovery in second half of FY26 or FY27. Three feedback which I wanted to highlight here. One, obviously, as you highlighted, investors were worried about muted loan growth in sector. So between end of March 2025 to end of May 25, so for the first 2 months of this financial year, credit outstanding for banks is broadly flat versus, let's say, 2.1% growth same period last year. Now, this series of steps taken by the RBI in last 6 months, like repo cut, CRR cut, easing of various, guidelines on gold loan, project finance, LCR regulation versus draft regulations, and deferment of ECL guideline were very well received. This should lead to improvement in credit growth in second half of FY26. Having said that, still investor credit growth expectation for FY26 was more like 11% YOY right now, lower than, let's say, 12 to 13% YOY expectation in March 25. So there is a decline in the expectation. While we believe that there is going to be pickup in, let's say, credit growth in the second half, but there is a decline in the expectation, let's say, compared to 2 months back. So the reason for this, I think, material improvement in credit growth in FY26 is unlikely until unless, income level of the larger population improves, which leads to a real increase in demand. So that's the main reason why we believe that, credit growth for the full year should not be more than, let's say, 10.5 to 11% on a YOY basis.
All right, we take that point. I look at some of your top picks and you are positive on SBI, BOB and Axis Bank. I'm a little curious about Axis Bank because there are a lot of people who, met with analysts, etc., met with the companies, etc., and said that maybe for Axis Bank, the growth looks a little muted in the first quarter. Yeah. Despite that, your positivity, if you could explain?
Yeah, you're absolutely right. So, I mean, the loan growth for Axis Bank is relatively lower as compared to some of the other large banks. But having said that, when there is a decline at the sectoral loan growth itself, the other large banks will also see, decline in the loan growth, whether it is ICICI Bank, whether it is, let's say, Kotak Mahindra Bank. In most of the places, we will see, growth decline in this year, financial year versus last year. There is going to be a broad-based slowdown in loan growth for the NBFCs as well. In that scenario, when we compare Axis with somebody else, let's say like for example, ICICI, Kotak and SBI, there is a value differential, right? And when the delta between, let's say, loan growth of Axis versus others comes down, valuation-wise, Axis look much better as compared to some of the other large banks.
Okay. Ajit, one key point that you mentioned and something that the street is tracking very closely is the net interest margin.
Yeah.
For banks, it's expected to moderate in H1. You're saying it's expected to remain flat in H2. Why? And number two, a lot of optimism is built around the NBFC pack, especially given the kind of rate cuts that we've seen. You don't seem to be so optimistic. Why?
Yeah. No, so we have made peace with the fact that for banks, margin is going to decline in first half and that largely be flat as the positive impact of CRR cut, flow through in second half. So CRR cut is getting applicable from September onwards, which is going to give, positive impact on the margin side. However, for some of the NBFCs and mid-sized bank with higher share of floating, higher share of fixed rate book, the general expectation is margin is going to expand in this year versus, let's say, FY25. But our sense is this is not going to be happening in this rate cut cycle. The reason for this is we are getting into this rate cut cycle when there is a elevated pressure, elevated asset quality pressure in the unsecured loan. Now all the mid-sized banks and NBFCs want to get into secured segment all at the same time. So everybody wants to do affordable housing, everybody wants to do vehicle financing. So there is a shift in loan mix which is happening from unsecured loan to secured loan. And that is leading to, pressure on the margin side. And there is a, elevated pricing pressure in the secured loan as well. And that is why we believe that FY26 margin for most of these names should either be flat or, let's say, in a best case scenario, only marginally higher, maybe let's say 10 to 15 basis point higher versus FY25 against, let's say, 100 basis point of rate cut for, rate cut that we have seen. Even the management commentary suggests, in a similar line, like for example, Bajaj Finance, right? In their investor presentation, they have said that, cost of fund will go down, but my margin is going to remain flat, on a YOY basis. That basically means that yield is under pressure. We cover roughly 30 to 35 names here, and more than, let's say, 25 to 30 names have reported decline in yield in fourth quarterly result. So even before we could have seen, benefit on the cost of funding side, yield is under pressure. There is no pricing, power for the lenders, when the sector loan growth is muted.
That really, points to the problem that we're looking at here, Ajit. We're not as worried about margins because that will take care of itself if the loan growth does come by. You spoke about higher competition. You spoke about, similar profiles of people who everyone is now chasing that has a pressure on the yields, etc.
Yeah.
So whether growth comes by or not is the big macro challenge right now. But the important point here, you said you cover about 30, 35 names in the space. I don't know whether it's conspicuous by its absence or you don't, cover this name. There's IndusInd Bank. And the reason why I ask you very specifically is about 7 days ago, there was a large, foreign brokerage that changed its view on the stock. And this was the first after that entire debacle that we saw on IndusInd Bank. So are you tempted to bite the bait here with a stock which is 50% lower? So if things remain the same for everyone, how much of that is in the price, etc.? Would you have a view here?
Yeah. So on IndusInd Bank, we have a hold rating. The reason for this is, I don't want to look at, IndusInd Bank fundamentally till the time, all the mess is cleared, right? So, after every, let's say, 1 week or 2 weeks, there is one news or some other news which is coming out. So till the time, all those mess is, completely cleared. Till the time I don't have confidence on the, on this softer aspect. We don't want to look at, IndusInd Bank at this particular point of time, from fundamental perspective.
Just as an right, no, just as an academic exercise, have you done, the worst case scenario analysis, bear case, what would the stock be priced at, and basis which, where is it right now?
So see, fundamentally speaking, even in best case scenario for IndusInd Bank, ROE trajectory should not be more than, let's say, 7-8% going into, let's say, FY26 and FY27 as well. I don't think IndusInd Bank will be able to cross, double-digit ROE by FY27 as well. Given where the valuations are, things looks completely, priced in. But having said that, as I said, the moment, I have greater confidence on some of the softer issues, we will obviously, have a relook at the name.
Well, thank you so much for joining us. It was a very good conversation and also moderates some of the optimistic expectations that the street has built in. But it's now time for a quick break. Pritesh Mehta from Yes Securities will join in with some trading strategies on the other side. Stay tuned.
Welcome back. Let's look at the market. For the last couple of trading sessions, the Nifty has been selling off from the highs. Today, the good part is it's holding around the 25,200 mark. Whether it goes up from here or not is the big question. The answer to that will be where the Nifty Bank goes, because right now, the Nifty Bank, which is off high, significantly off highs right now, sitting with a gain of just about 100 odd points. So we'll watch out for that, but no complaints from all the other sectoral gainers as well. We have, for the first time in the last many days, diverse sectors moving. We have Nifty IT on the one hand, we have FMCG on the other hand, we also have infra and auto, all of them fairly in the green. And the broader markets, they're doing actually a shade better, at least in the market breadth and the small cap indices. The small cap index is up around 1.5%. If you look at the market breadth as well, fairly solid, 2,000 stocks advancing for about 600 stocks, which are declining. And as the market digests the truce for the next day, we have India VIX, which is now moving towards that 13 mark. So ahead of expiry, that is, good news from the stability of the market. However, where the market goes from here on is dependent on whether it holds on above that 25,200 mark or not. Why is that? Because the initial bout of short covering by call writers has taken place already. You can see the 25,100 call writers covering their positions. You can see the 25,000 call writers covering their positions as well. But now, at lower levels, we have the 25,200 put writers, which are fairly active, and we have the 25,150 put writers also equally active, telling you that the support for the market is closer to 25,100 to around 25,075 itself. On the way up, 25,200 call writers are still active. So if the Nifty holds above 25,200, these call writers, all 1.5 crore of them, will have to cover their positions. The key is for the market to hold at these levels. And more importantly, if you're looking at a bigger level, then yesterday's high of 25,318 is important to cross for further short covering on the Nifty. In terms of stocks, I'm watching out for a couple of them. Yesterday, we had pointed out the possibility of Titagarh re-entering FNO ban. Chances are that it may exit FNO ban. And RBL Bank and MCX are the two candidates which might enter FNO ban one day ahead of expiry. Vivek.
Well, thank you so much, Mangalam. So your call is MCX and RBL Bank. These are the ones that are likely to enter the FNO ban today. Well, Pritesh Mehta from Yes Securities now joins in on the show for a quick technical check on the market. Thank you so much for joining us, Pritesh. What are you making of the Nifty as well as the Bank Nifty at current levels? It appears as though markets are struggling to sustain at higher levels.
Good afternoon. So see, yesterday also we had a steady start. At one point of a time, Nifty was up by almost by 300 points, but it closed by just 70 odd points. It shows the market is lacking strength at the top. It's lacking that directional strength and momentum also. But despite that, despite the external news flow, bottom markets are outperforming. They are doing well. So even today and yesterday's session, bottom markets have been doing well. So in a scenario where the index is not moving much, not doing much, but bottom markets are standing on their own, it shows that rather focus on the index, we should be focusing more on the bottom markets. They are outperforming. Whether you look at the Nifty 500, whether you look at Nifty mid cap or Nifty small cap, these are the space we need to focus on. I think Nifty, on the broader sense, it could continue to be range bound, but bottom market is space to watch out for.
All right, we take that point. And what individual stocks are you backing right now, Pritesh?
So yes, see, we have our customized customized capital market index, and it has been improving since the May end. And we can see several stocks are popping up in our buy list. One of them is CAMS. Now, CAMS is a we have seen a break of a 45-degree trend line on our Pontifical chart, and now witnessing follow-through moves. So we are expecting a big run up in this stock. We are talking about 20% rally from here on. So buy for a target of 5,200. The risk management level would be around 300 levels. And the second stock is FSL, First World Solution. Now, now IT index for 2025 has been a big laggard. But what we are seeing is that mid-cap IT has been doing well. Even the structure of our customers' mid-cap IT index is improving. So within this space, FSL stands out. We have seen a bullish turtle breakout coming in this stock, and we are witnessing follow-through moves. So buy for a target of 450. The stop loss would be around 380.
Thank you so much, Pritesh, for joining us, giving us a view on the market as well as an individual stock call. Well, it's now time for a quick break. On the other side, Manisha Gupta joins in with Devinder Sharma of Agri Economist. Stay tuned.
Welcome back, and joining us on the show now is agri-economist Mr. Devinder Sharma. Mr. Sharma, hi, thank you so much for joining in. First, your sense on the kind of Kharif numbers that we seem to be getting. 10% sowing more than last year. Of course, there's a disparity on what is getting more sown. We've clearly seen some decline in soybean, some decline in tur as well. This is where we did not get MSP for many of those farmers. But what is your overall sense?
Well, I think, first of all, it looks very exciting when we hear the 10% increase. But when we look at the numbers, it doesn't give us any encouragement. First of all, the area which has increased is that of wheat, a little bit, I would say. And then, of course, there's a decline in oil seeds and pulses, which is very crucial because in the last 1 year, we have imported about 46,000 crores worth of pulses. So the farmers are not finding any excitement in growing pulses anymore. And also the area under oilseeds has shrunk. The reason you spelled it out clearly that soybean farmers are not getting the right prices. So why should they go in for enhanced sowing this particular year? So I guess it is a mixed bag, and I think it should be very clear and obvious that the price policy has to change to encourage farmers to bring more area under pulses and oilseed, which is the requirement today.
Mr. Sharma, when you say the price policy has to change, what do you really mean with that? Because the MSP increase is something that the government has been pushing on in sense of price increase for farmers.
Yeah, but if you see the price increase happens at a time when the imports are coming in. So if the cheaper imports are coming in, you will see that the prices get depressed in the market, as a result of which farmers don't get the right price. Now look at soybean, for instance. Against the MSP, which is higher, the farmers are getting about 4,300 to 4,600 per quintal. And so therefore, there is no excitement for them to go or shift towards soybean. The area under pulses has also decreased because the shift is now towards wheat, simply because there is an assured price there. So I think the government has to formulate a policy. Two things must be assured. One, of course, the right kind of price. And second, the imports are not coming at a time when the harvest begins. And that is something which we have to be very careful, because pulses is a victim of that kind of a price folly.
Ms. Sharma, there is just so much conversation around GM right now. While while a lot of people believe that it can increase productivity by 15 to 20%, you're anyways importing a lot of that. But the kind of resistance that we've seen on GM also has been on the higher side.
I think, let me be very clear, there is no increase in productivity anywhere in GM crops. Let me be very clear on that. And I think this feeling or impression has been given by the industry, and I include the GM industry in that. The classical case is that of cotton. We had BT cotton in India. We have seen the collapse of BT cotton recently, and nobody has raised a question. And even prior to that, when the increase happened in the initial years, when the introduction happened in India, the GM crops introduction happened in India, that was not because of any advantage that the GM offered. It was because of other factors like irrigation and fertilizer increase. And this has been demonstrated in an excellent paper published in the very important magazine called Nature by a former director of the Cotton Institute in India, and along with an economist, sociologist in America. Now, that is a very important paper which tells us that the increase was not because of GM seeds, as was given or we were given to understand. So I think it should be very clear, GM is not the answer for our increasing productivity, it is the price. Let us provide a higher price to farmers and you will see they raise the productivity. For instance, the case of pulses. If pulses prices were higher, there is no reason why Indian farmers wouldn't have taken that offer. The result is that we have not been able to provide the right kind of prices, so farmers don't see any incentive there. So it should be clear to all of us, it is not GM. And GM, of course, has health concerns, as we all know. We are not a GM nation. So why should we take that line that we need to import GM maize or GM soya? No, we don't need to do that. It will also impact our exports of soya meal, because globally there is a demand for non-GM soya meal, and that India is a country which they are looking up to. Why do we want to lose that option also, or the advantage also? So I think it is very clear we don't need GM, we need healthy crops, and the productivity increase can happen without GM. GM was just an illusion that has been created in this country.
I want to come back onto the cheaper import part of this. And while we've seen that happen in edible oils, we've seen that happen in pulses. I was reading a latest report, Mr. Sharma, and that tells us that even cotton imports, now India does seem like a net importer, because from 15 to 17 million bales last year, or rather this year, it looks like we'll be importing 40 lakh bales rather. So from being a second largest producer, and even with an 11% import duty, it does feel like the cotton imports are cheaper into India.
You're very right. And I think cotton is a classic example where the GM experiment has gone wrong. The GM bullet that we all talked about has bitten the dust. It happened in China first. It is happening in India now. In the last 2 years, if you have seen, the area under cotton in Punjab, Haryana and Rajasthan is at the lowest ever. And that tells you that, the farmers' love affair with cotton has gone. And that has gone for two reasons. One, of course, is that the GM crops varieties failed, and failed miserably. And the second part is that we are not able to give the right kind of price to cotton farmers. So both the things, I think, should be an eye-opener for all of us, that we, for boosting the productivity or production within the country, we need to ensure that there is an adequate and assured price, A, and B, we do not go fall for such fallacious kind of argument which say GM is the answer. GM has not been the answer anywhere, including China, which initially had shown remarkable productivity, but then everything crashed as far as the GM crops were concerned in China. So what is happened in India is a repeat of that same performance, and I think that should be clear, that GM is not the future ahead.
Well, thank you so much, Mr. Sharma, as well as Manisha, for joining us and giving us an insight into this very interesting as well as important topic. Well, we'll now slip into a short break. We'll get you more on the markets and focus on Dixon Technologies on the other side. Stay tuned. Welcome back to Halftime Report. Well, the market continues to see some selling pressure from the higher levels. Some of the different stocks yesterday that did see some bit of selling pressure emerge today continue to see some moderation. Names like Masgao Dock, IOC, some of the names like BDL. These are some of the stocks that are under pressure today. But another stock that's under significant pressure is Dixon Technologies. Phillip Capital today in a report has flagged off growth concerns for the stock. Upasna joins in with more details.
Well, certainly the brokerage has flagged off some growth concerns here. Well, it has maintained the sell call on the stock with a target price of 9,085 per share. Now, the brokerage says that Dixon was sole manufacturer partner of Motorola last year, but this trend has changed in this year, that is CY25, with Motorola routing some of its volumes to Carbon in this year. Now, in Feb and March in the current year, this outsourcing was minimal, but when it comes to April and May, it accounted for nearly 25% of Motorola's monthly volumes, which were diverted. Now, Phillip Capital says the initial estimate suggests that this figure can rise as high as 35% by June. Now, coming to the Dixon's second largest client, that is Longcheer, it may also outsource some of the incremental volumes to Carbon, is what the brokerage estimates. For Dixon, volumes from launch year have grown, looking at the past trends. But in May this year, that is CY25, launch year also started beginning outsourcing a small 2% share to Carbon. And brokerage believes that this share can also quickly rise up in the upcoming months. Now, on the back of this, Phillip Capital has reduced its FY27 estimates for the company. It has reduced revenue by 4%, EBITDA by 6%, and PAT by 9% on account of higher competition in the mobile phone assembly space and citing some of the growth concerns for the company going forward. So all in all, certainly we can see the stock under pressure today on the back of this note.
Take that point, Basna. Thanks a lot for that. The promoter recently sold some stake. Brokerage is not very positive on the stock, down by almost 2.5% from the peak. It has seen a bit of a cut as well. With all of this, let's take a short break. And as we do that, let's tell you about CNBC-TV18 Prime. What is that? It brings you insights from policymakers, business leaders, economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses. Gives you unparalleled insights as well. You can tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. every weekday. Welcome back. Just keep an eye on a couple of stocks from the broader markets. We have Sammaan Capital, which has seen a big move, almost 17% higher right now. And most of the gains have come by in just the last 15 odd minutes. So just watch out for that one. MCX continues its move upwards. Dixon Tech is the other one, which is now down 3%. And that's largely because of, promoters selling. More importantly, a negative note coming in from a brokerage as well. So that's extended its cut. We had Upasna talk about the reasons for weakness just moments ago. And just pull up Sammaan Capital, the intraday chart. That comes up for you. A big move is what we're seeing. And Bazaar Style Retail, that's the other stock, backed by strong volumes, up around 8% as, we're looking at the broader markets right now. 2,000 stocks in the green versus 600 in the red. With that, we'll wrap up on this edition of Halftime Report. But you don't go anywhere because you have Business Lunch coming up next.